Good afternoon, everybody. We've got a great webinar. We're joined by Joe Vaclavik from the Standard Grain. Thanks for joining us, Joe.
Glad to be here. Happy Friday.
Yes, definitely. We'll get into it in a little bit, but a special thanks for joining us because it's such a crazy ag day. Right now we have corn down 3%, wheat down roughly 3%, soy down 4.5%. So we'll get to that in a few minutes, but crazy
hmm
moves.
Yeah, big moves on a very bearish report.
Yeah. So take me through, tell us a little bit about yourself, your background in the markets, things like that.
Well, I started in the commodity business in 2005. Um, I kind of stumbled into agriculture. It wasn't something that I really set out to do. What happened was this: I went to school at the University of Illinois. They've got a big ag program there, and I stumbled into a couple of different ag business classes back then, and I thought it was real interesting. My original intention was to do something along the lines of like a finance or business degree or something similar to that. And I took these ag classes. I thought it was interesting. Here I was kind of sitting in the middle of the Corn Belt in Champaign, Illinois, and I thought, something, I'm gonna do something a little bit different. And I did, and I went through and did the major. And I think it was my junior year that some internships were tossed around, and they were in Chicago, and I was from Chicago. So I took advantage of that. I applied for a bunch of them, got one of them. I worked through college then, and then out of college for a number of the bigger brokerage firms in Chicago that were doing ag business at the time. I worked for MF Global, which was, the big firm that went bankrupt in 2011.
Sure.
And I was on board for all of that, which was a fun time. But once that happened, I started my own business after the bankruptcy. And that's where I am here today. I've got a customer base that consists of, mostly large scale agricultural operations. We've got a lot of large scale row crop farmers in the Midwest, large scale wheat growers in the Southern Plains. I've got some cattle feeders, some hog feeders, some commercial grain facilities, some ethanol plants, things along those lines. And my job basically is to do brokerage and provide consulting and advisory in regard to commodity buying and selling.
Interesting. So I guess from speaking to all those different people, you get a lot of different flow and a lot of different information, a lot of different viewpoints, things like that.
Tons of information, tons of different opinions, which are often difficult to digest and analyze. My whole thing when it comes to my business and what I do here and the way I do business is really margin based. So if you're an agribusiness of any scale, you should really be concerned with operating margins more than anything. For people in that kind of business, whether you're a farmer or a cattle feeder, predicting prices or speculating on these markets is not your job. Your job is to lock in profitable margins and make your business profitable. So that's really the name of my game here, is to do that. I mean, I've always got an opinion on the market, but what I'm more interested in than market direction per se is being able to help, whether you're a producer or end user, being able to help you to lock in profitable margins for your business using either futures and options contracts or cash contracts or whatever it may be. That's what I'm most interested in.
Interesting. And so, what do you do with all the information? Like, how do you decipher and do you come up with your own opinions based on, like, speaking to all the different players that you speak to?
Yeah, I mean, I'm not short of opinions, just like anybody else who's been in the market for any period of time. I try not to let my opinions of market direction or opinions of just markets in general dictate what I tell my customers. Now, I do have some, high net worth investor types that, are trading the markets on a purely speculative side. And that's where an opinion or an actual trade recommendation or something that's purely speculative may come into play. I do that. Not as much of it as I do on the hedge side. But for me, like I said, I've got an opinion. I'll tell a customer what my opinion is, but the margins and the profitability aspect for these agribusinesses takes precedent over anything that I really believe about the market.
Right. And so, do you use technical analysis at all when you're looking at the markets, or purely fundamental driven from, just speaking to your contacts?
No, I do some chart work. I would call it very basic chart work. My one of my goals when working with customers is to lay everything out very clearly. I don't want to confuse anybody. So I try to really keep things as simple as possible. I like doing naked charting, which is what some people would refer to as I try to pull up a fresh chart without any indicators every day and try to, establish some sort of pattern or something that's easy for a novice to follow. I try not to overcomplicate this stuff. I'm not going to send out customers, MACDs and oscillators and all sorts of intricate stuff. I'm going to send them out something with the trend line or a trend channel or some sort of range that's been established within a market. I really try to keep things simple. And to be honest with you, it's worked. I feel like simplicity, at least for me, and every trader is different, but simplicity when it comes to charting for me is what has worked best.
Yeah, that makes sense. So how has the way you looked at the market, let's say 5, 10 years ago, changed versus what you're doing now?
Oh, much different. I mean, as you mature in this business, in any business that's related to markets, I think the way that you view things should change because you're constantly learning on a daily basis. I mean, every day you learn something new, which is one of the more interesting parts of doing this kind of work. Um, I would say that I would say now I'm probably less opinionated in regard to the markets than I used to be, which might be kind of an odd statement. A lot of people maybe become more opinionated over time, but I've realized that my opinion is just one of a million in these markets. And given the type of business that I do, again, I do a lot of hedge business and my job really is to lock in profitable margins. I've just realized that in that line of work, my opinion doesn't matter as much as a spreadsheet that tells me just how profitable one of my customers is. That's what's really more interesting to me. So I mean, that's what's changed for me. I when I got in the business and I knew enough to be dangerous with it, I'd say I probably had some stronger opinions about things than I do now. I mean, I've always got an opinion on any of the grain markets, whether it's corn, soybeans, wheat, or even cattle or livestock or those sort of things. And you're always going to inherently have those opinions when you're involved in this stuff, but I would say that my I don't know what the word I'm looking for is, but my opinion, they've kind of dropped off a little bit. I'm just not as opinionated, and I try not to be as opinionated. I try to be very objective and not as subjective.
Right, right. And then getting back to what you were just saying before, from the hedging side, is it, we're right here, fairly historically low prices in corn and soy, or at least in, let's say, a 10-year range, things like that. Is that side is it easier with lower prices or harder? And, is it more beneficial to have prices that are, let's say 30, 40, 50% higher than where they are, just from the hedging side?
I would say that doing marketing, so doing the type of hedge business that I do, it's probably easier to be correct with your marketing advice in a market like this where we're range bound. I just tweeted out a corn chart for the last 4 years this morning, and the corn market's been confined to a range of $1.40 for the last 4 years, which relative to say the 5 or 10 years prior to that was a very narrow band of prices. So I'm never going to say that this job is easy because it's not, but I know now that when we get toward the upper end of what's been that 4 year range, that I need to be doing some marketing and I need to be laying off some risk. And I know that when we're toward the lower end of that range, that I need to be locking up needs for end users and that sort of thing. And one day that won't work, and one day we're going to break out of this range. It could be this year, it could be 10 years from now. But I would say in general that when you're in these range bound markets, that doing this sort of business, this hedge business, where you're trying to lock in margins for producers and end users, I would say that a range bound market actually makes it a little bit easier, to be honest with you.
Yeah, I guess opposed to, that makes sense, opposed to high
When you run into the
volatility.
big volatility and you run into, say a crop scare market, like we just saw a little bit of that in the wheat market. Markets can exceed your wildest expectations. In 2012, the corn market went to $8. Nobody thought the corn market would ever get that high. So that was a year where, just about every piece of marketing advice that anybody gave was wrong. I mean, everybody was selling the thing on the way up, $5, $6, $7, and they were all wrong because we went to $8.50. So in a market like that, it's difficult to look good as a market advisor in my line of work. Whereas in this sort of market, when you're confined to these multi-year price ranges, in the instance of corn, soybeans, and wheat, I would probably make the argument that it makes it a little bit easier, to be honest.
Right. No, well, that makes sense. And so, how do you analyze risk, just on a day-to-day looking at the markets?
Well, the thing about risk and as far as it relates to agricultural operations, an ag operation in a vacuum, one ag operation is a business. And just like any other line of business, everybody's business is set up differently. Everybody's got different profit margins and different break evens and different prices in regard to corn, soybeans, wheat, cattle, whatever it is, different prices that work for them. So what I need to know as a risk manager, when working with customers, I need to know what their numbers are. I mean, I can't. It's tough to just throw out blanket recommendations, although we do a little bit of that through our newsletter and stuff. But more of the bigger customers we deal with one-on-one. You've really got to know the numbers. I mean, it's just like, say you have a tech business. I mean, not every tech business has the same margins. Or say you're a car dealer. I mean, not every car dealer has the same margins. Farming's no different. I mean, you've got farmers that are heavily in debt, that are heavily leveraged. You've got other farmers that have their entire operation paid for in cash, and they operate in cash. And they've got a higher risk tolerance. So I guess the answer to that question is that you've got to know who you're dealing with, and you've got to know their risk tolerance. You've got to know what their goals are, and that's really a big part of what I do day to day, is deal with customers and try to identify exactly what their goals are and what type of prices or profits we should be shooting for.
Right, right. So right now in the marketplace, what sort of signals and do you look at and focus on the most?
Signals in terms of like a technical signal. I mean, I'm just trying to identify ranges. So I just like I said earlier, I know that in corn, if we get anywhere north of say 410 futures, that's probably where I need to be selling some corn. If we get down closer to 3 or 3.25 corn, that's where I need to be locking up some corn for end users. So in terms of technical signals, I mean, I wouldn't say that there's a whole lot out there that I'm looking for in particular. I mean, I'm not looking for any sort of specific chart pattern or anything that I really hang my hat on from a technical standpoint. I do like to watch fund movement and movement from large speculators. I think the CFTC reports and the positioning of the large speculators, of the managed money of the funds, is very important. I'll tell you this: if you want to look for a time to market grain, historically, if funds build up a long position in the market, that's probably when you should be making some sales as a farmer. If funds build up a very aggressive short position in the market, that's oftentimes a time for an end user, whether you're an ethanol plant or you're an import or whatever, that's oftentimes a good time to be locking up some needs and be getting long the market. Really like those CFTC reports, and I like what they provide us. It just tells you when the boat's loaded too heavily in one direction, a lot of times you're due for a move in the opposite direction.
Sure. But more so on the signals also, is there some, whether it be more on the fundamental side, are there certain things, whether it be weather or certain producers that you speak to, or certain things that kind of tip off that, wow, corn's staying offered here, or wheat, is ready to, continue to move higher, things like that?
Seasonal tendencies are a big thing in the grain markets, and I'd say that maybe they used to be bigger than they are now. But historically, like just to give you one example, if you get a crop scare event in the corn or soybean markets, you run into some adverse weather in the United States during the summer months, which are very important in regard to crop production. That's often going to cause a spike in prices. And I know that historically that those spikes in prices, if they occur, are generally some great selling opportunities. So that's not maybe a technical signal, but it's definitely a fundamental signal. I mean, the market gets worked up and there's no certainty in regard to what's out there in terms of production. That's often a great time to do some marketing. And I was just talking about it on your website here today about the wheat and what we've seen. And it's something similar. We've seen a crop scare event, but it's on a global scale. And when you see a crop scare event, what it means essentially is that the market has no idea what production is going to be, and large speculators are going to step in and bid the market just because of that, because there's enormous uncertainty and there's possibility of just enormous production declines. And usually producers avoid selling during that time frame because they're not certain what their production is going to be, which kind of extends the rallies in some instances. And those type of events generally offer some good selling opportunities. So that's one of the things I look for. Weather scares or crop scares are a big thing that we keep an eye out for at all times. They're generally good marketing opportunities. It doesn't only relate to the U.S. in corn or soybeans. We'll get South American weather scares sometimes. They're the other big producer of these row crops in the world, and you get a South American weather scare over the winter. That's often a good time to sell some grain. So from a fundamental standpoint, I'd say that that's probably my biggest indicator. I love selling a crop scare rally. That's a good way to get you in trouble short term, but it's generally a good deal long term.
Right. And then, I know I was actually just reading an article. I got bombarded. Australia drought. Does that affect anything locally, or are they?
Absolutely. Yeah. The wheat market's very much a global market. And without getting too specific here, the U.S. used to be an enormous player in the world wheat market. We used to have a real big share of global wheat business, and our share of global wheat business has declined over the last 20 or 30 years,
Right.
to the point where we're just kind of now a residual supplier to the world. We've seen big production increases in places like Russia, places like the EU, places like Australia, and they've really kind of taken our place as a big exporter. That's part of the problem with the wheat market, and that's why I've been kind of negative here following this rally. We just don't have demand for wheat in the United States. It's very difficult to build demand. And so, yeah, when you get something in Australia, the wheat is very much a global market, and that has affected prices undoubtedly.
Sure. So tell me this: corn, wheat's just had a big pickup over the past quarter or two. But with corn, soy, wheat, the prices have been pretty depressed. How are farmers coping in general over the past decade? Because it seems like everybody's always talking about higher prices, but they never come.
Yeah, we've really been waiting years now for some better opportunities, and we haven't seen them. So over the last 10 years have been really interesting. So what happened, and this is right when I got in the business, I got lucky in terms of timing and when I got into this business. So in 2005, that time frame is around when the government put this ethanol mandate into place, which increased corn demand substantially. So it led to a period of profitability for farmers. Some of the best years that farmers in the U.S. have ever seen occurred from 2005 through, say, middle of 2014. Farmers made a lot of money during that time frame. Margins were very good. Prices were up, demand was up, and cost of production was still kind of low. Now, 2012 kind of changed everything a little bit. 2012 was the year where we had corn prices go to $8. We had a historic drought in this country, drought of that occurs once every 50 or 100 years. We had the soybean market go to $16 and change. And what that did was it drove up input costs for farmers across the board. Every seed manufacturer, every fertilizer dealer, equipment manufacturers, landlords, all decided that, hey, the farmers are making so much money this year. And make no mistake, farmers did really well in that drought year because prices were so high despite short crops. 12 and 13 were some of the best years in terms of farm profitability. Everybody raised input costs, and they haven't come down since. So you're dealing with input costs that essentially were set in a much higher market, and now your commodity markets have come down, but your input costs have only seen minimal declines. So it's left the farmer in a tough spot. I mean, farming's always been a business with razor thin margins, but it's even more so now, and the stakes are much higher. So capital intensive. It's just costing an enormous amount of money to put a crop in the ground, and you're hoping to just get a small portion or small return on top of it.
Yeah, because you constantly hear how the farmers struggling, and
Mm-hmm.
whether it be through subsidies or different things, they continue to be in a pinch.
And again, you got to be careful what you read and what you pay attention to, because there are farmers. I mean, I know farmers. I have customers that are in fantastic financial shape, and I have customers that are not in so good financial shape. A lot of it depends on how much land have you owned and how long have you owned it. What kind of debt are you in? How much land are you renting? What kind of leverage have you really opened yourself up to? So it really varies. I would not go. I don't believe the blanket statement that every farmer in this country is in trouble, because that's just not true. but there is certainly an element of trouble, especially this year with this trade war and big crops coming again the way that it seems. Things aren't great, but it's not a dire situation either.
Right. Well, that's actually good to hear because it does sound dire when you read a number of different media reports or things like that. Not diving as deep into it as obviously you have a lot of firsthand knowledge. But similar, what you just said, let's take off on that point, the trade war. How is that affecting the individual farmer and how they can possibly plan for the future?
So I think that the trade war's impact on prices has been greatly exaggerated. First off would be my statement there. So everyone says, okay, soybeans is the big crop, right, that we sell to China, and that's the big problem. When we look at exports, I mean, we're not going to see, according to USDA, a massive decline in exports of soybeans out of the U.S. this year by any means. We're going to see a decline, but it's not a massive decline. We've seen other global buyers, everybody except for China, is stepping up to the plate to buy soybeans out of the U.S. because there's a massive price discount here. Brazil and Argentina are the other big world suppliers of soybeans. They are priced 20% above the U.S. because China has gone to them exclusively for beans. So we may very well run into a situation here where China buys beans out of the U.S. despite the tariffs, because we've got such a steep premium in Brazil with beans versus U.S. prices. You could actually see this thing kind of blow up on itself, and you could see China come back and buy beans from October through, say, March. That's usually when they buy beans from us. It's when there's a gap in South American supplies. So the verdict on this thing is out. I mean, China is an interesting deal. It always is. And some people are projecting that their soybean imports are going to be down year over year. I'll believe it when I see it because they've done nothing but increase demand year after year after year. So if China decides to start buying soybeans more aggressively out of the U.S. in the next, say, 6 to 8 weeks, despite the tariffs, that would not surprise me one bit. And that's something that would be kind of friendly for the market. So I do believe that the impact of the trade war in regard to soybean prices in particular and just grain prices has been exaggerated. I think that people look at the market and they just want something to blame. But the reality of the situation is we've had several years in a row of excellent production. We've expanded acreage here in the U.S. because prices were generally profitable relative to other crops. We've had good crops out of Brazil pretty much every year. They expand acreage every year. So we've had a bare kind of supply story there for a while. And this China thing just maybe was the straw that broke the camel's back here for the moment. But I mean, there were other bearish factors out there other than this China thing, undoubtedly.
Right. Well, that actually kind of gets into something I was speaking with Angie about earlier in the week about technology as well, just how efficient everything is, in terms of every acre, people literally knowing every inch of land, exactly how the soil is, and to optimize growing, which creates a great crop.
Right. And we haven't had bad crops here in the U.S. in a long time. I mean, we've had, what are we going on, 4 or 5 years now of trend or above trend yields in corn and soybeans in this country. So we've had an extended run of good production. A lot of that has to do with weather, but the farming practices are just really phenomenal. I mean, you hop into a tractor during planting, you hop into a combine during harvest with a farmer, anywhere in the Midwest, and the technology would shock the common citizen who hasn't been around modern farming. You talk to somebody from the city, or I'm from Chicago, so most of my friends, my family, they have no idea what it is that I even do. Huh. But if somebody like that hadn't been exposed to it, were to jump in and spend a day with some of these guys, they would be shocked at the technology and how it's made advances in the last, just over the last 10 years.
Right. So let's take a look at today's figures. Huge moves. Like I said before, we're at corn's down 3%, wheat's down 3%, soy is down almost 5%. What was the data?
So the big ticket items on today's report were the yield numbers, in particular yield per acre in the U.S. and the soybean yield number came in well above expectations, 51.6 bushels per acre, which would almost be a record. And it was a couple bushels above trade expectations. That was the real big bearish number. And when you look at the balance sheets, and this is what a lot of people in agriculture do, they look at the balance sheet, supply and demand, and where is everything going and where's everything coming from. We've got a big carryout projected, and what a carryout is essentially the amount of bushels that are left over at the end of a marketing year. We're looking at an all-time record high carryout in soybeans on August 31st next year, according to projections right now. And this could change. The yield numbers could change. This is just a preliminary yield estimate from USDA. It's August. We haven't harvested the crop yet. It's a projection. It's an estimate. They'll get a little bit more accurate as the months go on. But that was the big bear number today, was the soybean yield number. And the corn yield number was also a little bit negative. And I would say that the report in general just had kind of a negative tone. You throw the landscape of this trade war on top of it. You throw a dollar that's rallying into fresh 12-month highs on top of it. You just got yourself an ugly market.
Yeah, well, like you said, you named the other catalysts on top of it as well. So I guess we're pretty much near the low of the year for both corn and soy here. So we'll keep a close eye on that. All right. Well, hey, thanks. There was a lot of great information. Look forward to hearing from you in the future, and keeping us updated as everybody's keeping a close eye on the ag market.
Sounds good. Well, it was nice to be on the webinar here today. I hope everyone has a nice weekend.
All right. Thanks. You too.
Yep. Bye now.